Welcome to Tesla Daily News Podcast. I'm your host, and today is Wednesday, March 18th, 2026. In the next few minutes, we'll break down the most stock-relevant Tesla headlines, a major new U.S. battery supply deal for Megapack, Musk's latest push toward in-house AI chips, the Robotaxi competitive landscape heating up around Nvidia, and a quick check on deliveries expectations and what analysts are really watching. Story 1. Tesla just locked in a massive U.S. battery deal that directly strengthens the energy business. The hook. Tesla's energy storage supply chain just got a big, domestic upgrade. Context. Investors have been looking for credible, margin-supportive growth engines beyond vehicle deliveries, and Tesla Energy is the most visible candidate, especially as grids add renewables and data centers drive demand for storage. Details. Multiple reports say Tesla and LG Energy Solution have a roughly $4.3 billion agreement for lithium iron phosphate, or LFP, battery cells produced at LG's Michigan facility in Lansing. Production is expected to start in 2027, and those US-made LFP cells are slated to go into Tesla's Megapack systems, including Megapack 3 produced in Houston. LFP matters because it's typically cheaper and uses no nickel or cobalt, which can reduce cost volatility. Impact. For Tesla stock, the bull case is straightforward. Better supply reliability, potential cost advantages, and more confidence that Megapack volume can scale without being constrained by imported cells. The risk is also clear. As Tesla scales energy, competitive pricing pressure and potentially tighter margins can show up. Tesla's own CFO has previously flagged margin dynamics in energy storage. Still, securing U.S. LFP supply at this scale is the kind of operational move that can support higher energy revenue and improve visibility. Takeaway. Watch Tesla Energy as a separate growth narrative. This deal is a signal that Tesla intends Megapack to be a larger, more predictable business line and is investing in supply chain resilience to do it. Story 2. Musk is talking up Terafab and in-house AI chips, and the market is trying to price what's real versus aspirational. The hook. Tesla wants to bring more of the AI chip stack under its own roof. Context. Tesla's autonomy roadmap, Optimus robotics, and even certain manufacturing automation ambitions all depend on compute. Chip shortages and foundry capacity constraints have been a recurring strategic vulnerability across the industry. Details. Several outlets reference Musk discussing a Tesla Terafab concept, a very large domestic fab that includes logic, memory, and packaging, and one report claims a project start date as soon as March 21st. Other coverage frames it as a broader semiconductor push to reduce reliance on suppliers like TSMC, Samsung, and memory vendors. Impact. If Tesla truly executes here, it could be a long-term moat, but it's also capital-intensive. Building leading-edge semiconductor manufacturing can run into the tens of billions of dollars, and timelines are notoriously difficult. For valuation, the key question is whether Tesla is building differentiated AI capability that supports autonomy and robotics, or whether it risks becoming an expensive distraction. Any investor model that assumes major autonomy cash flows will need to consider the cost of compute, the speed of iteration, and whether Tesla can out-execute the semiconductor incumbents. Takeaway. Treat Terafab headlines as directionally important, but demand specifics, CapEx guidance, partners, node technology, and deliverable timelines. This is high upside if it lowers compute costs and accelerates autonomy, and high risk if it becomes a multi-year cash sink. Story 3. Nvidia is increasingly a valuation threat to Tesla because it can commoditize autonomous driving infrastructure. The hook. The more plug-and-play autonomy becomes, the less exclusive Tesla's autonomy narrative may look. Context. A meaningful chunk of Tesla's market premium is tied to the idea that full self-driving and robotaxis unlock software-like margins and huge future cash flows. Details. After Nvidia's GTC event, the company highlighted major auto partners adopting its Drive Hyperion platform for Level 4 autonomy development, including BYD, Hyundai, Nissan, Geely, and others. Separately, Uber and Nvidia announced an expanded partnership targeting a robotaxi rollout across 28 cities globally by 2028, with initial deployments in Los Angeles and San Francisco around 2027. Impact. For Tesla investors, this matters because autonomy competition is no longer just about who has the best stack, it's also about who can scale fleets and who has a platform partners can buy. If Nvidia helps many automakers and mobility networks accelerate to credible Level 4 capability, Tesla's autonomy advantage could be harder to sustain, and the market may assign a lower probability to Tesla owning the majority of the robotaxi profit pool. Takeaway. Track milestones, not hype. Real indicators are regulatory approvals, disengagement rates, commercial geofence launches, and whether Tesla can expand beyond limited pilots into a repeatable, scalable service. Story 4. A former Uber CEO says Waymo is ahead, while Tesla is chasing a ChatGPT moment for vision-only autonomy. The hook, the robotaxi race narrative is getting sharper, and not always in Tesla's favor. Context: markets can tolerate soft auto demand if investors believe Tesla is on the cusp of a step change in autonomy. But skepticism about timelines can pressure the multiple. Details: Travis Kalanick said Waymo is ahead because it has an existence proof, while Tesla has the technical fundamentals but faces a more uncertain timeline, especially because Tesla is pursuing a camera-based approach without LiDAR. He framed Tesla as chasing a breakthrough moment for vision-based driving. Impact: comments like this can influence sentiment because they reinforce the key risk. Even if Tesla's approach is cheaper to scale, it may take longer to reach robust, regulator-acceptable performance. That uncertainty can translate into higher volatility around autonomy headlines. Takeaway: if you're valuing Tesla like an AI autonomy company, you must be honest about timing risk. The difference between next year and 3 years is enormous in discounted cash flow models. Story 5: deliveries expectations are taking shape, and analysts are increasingly saying the stock trade is not about cars right now. The hook: Wall Street is preparing for another quarter where the delivery print may not be the main driver. Context: Tesla's recent delivery trend has been under pressure, and investors are debating whether the company is in a temporary demand dip or a more structural slowdown. Details: one note from Barclays kept Tesla at equal weight with a $360 price target and discussed first quarter delivery expectations. The analyst flagged a forecast around 350,000 deliveries, below a consensus around 375,000, but also argued a miss may not be decisive for the stock because attention is on robotaxi, humanoid robots, and autonomy. Impact: this is important for traders. If the market is in optionality mode, then delivery volatility may move the stock less than autonomy and AI announcements, until it doesn't. If deliveries or margins deteriorate sharply, fundamentals can reassert themselves. Takeaway: watch both layers. Near term, Tesla trades on autonomy and platform narratives. But longer term, the company still needs profitable volume and stable margins to self-fund big bets like chips, Robotaxis, and Optimus. Story 6: Musk teases a next-generation Roadster reveal in late April, but delays remain a credibility overhang. The hook: the Roadster is back in the headlines again. Context: Halo products can reinforce brand and engineering leadership, but repeated delays can also weigh on management credibility, a real factor for valuation when timelines matter. Details: Musk posted that the Roadster unveil is probably in late April. Other coverage notes the project has been delayed for years, with deposits taken long ago. Impact: near term, a Roadster reveal is unlikely to change Tesla earnings. But it can influence sentiment around Tesla innovation, especially if it showcases new battery, performance, or manufacturing tech that might trickle down. Takeaway: treat Roadster as sentiment and brand, not a major revenue driver, unless Tesla ties it to meaningful platform improvements. Let's wrap it up. Today's big themes were Tesla Energy getting a major $4.3 billion US LFP battery supply path for Megapack, Tesla's renewed push toward in-house AI chips with the Terafab concept, and intensifying robotaxi competition as Nvidia platforms spread across automakers and Uber's planned global rollout. What to watch tomorrow? Any follow-up detail on the Terafab plan, especially capex, partners, and timelines, plus new data points on first quarter deliveries expectations, and any concrete autonomy progress metrics. If you got value from this, subscribe to Tesla Daily News Podcast and follow us for a clear, data-driven Tesla rundown every day. See you tomorrow.